Welcome to PIMCO Pod. In this episode, we discuss how the outlook for modest fiscal reforms and increased defense spending are unlikely to significantly boost European economic growth. Stay tuned after the conclusion of the podcast for additional important information. Hope and Hype on German and EU Fiscal Reforms by Nicola Mai. Following the election of U.S. President Donald Trump in November and the February victory of the German center-right CDU-CSU party, led by Friedrich Merz, many market participants are speculating that significant changes in fiscal policy in Europe are imminent. Specifically, Trump's reluctance for the U.S. to continue as a guarantor of global security has raised expectations for increased European defense spending. At the same time, many believe the German election will prompt the nation to reform its fiscal rules in an effort to revive its ailing growth model. While we think any fiscal changes are likely to be incremental, the political winds may now be blowing in that direction. Modest reform in Germany. We believe that Germany's constitutional debt brake, which imposes a largely balanced central government budget, will be reformed over time. However, we also consider that such reform is unlikely to be radical, not least given the CDU's historically hawkish views on fiscal policy. Based on a proposal by the German Bundesbank, the debt brake could be modified to allow extra fiscal space equal to about 0.7% of GDP. While helpful at the margin, this change would provide a one-off boost to growth of about 0.5 percentage points, after which the economy would likely revert to its prior trend. However, this small-scale reform is unlikely to overcome significant structural headwinds: weak demographics, low investment and productivity, rising competition with China, and a trailing position in the global tech race. European defense spending and trade policy. Similarly, higher European defense spending is unlikely to be a growth panacea. Currently, the EU spends around 2% of GDP on defense, and could increase it to perhaps 2.5% to 3% in the future. Much of this increase would likely stem from national government efforts. In that regard, the European Commission is working on a proposal to relax EU fiscal rules to allow higher spending, while the German government appears to be working on a sizable near-term defense package. Reports suggest that the upcoming German package could be large, but what we've learned in the past is that we need to see details before raising our hopes excessively. Over time, we expect to see a more coordinated pan-European funding effort for defense. Initial steps could be to repurpose the roughly 90 billion euros, about 0.5% of EU GDP, of uncommitted funds from Next Generation EU, NGEU, the fund set up to address the pandemic-related economic crisis, and to introduce a new EU loan facility dedicated to defense for sovereigns. Over time, the EU could create a new facility that includes grants to governments, a sort of NGEU2, although this will require ratification by the various national parliaments, which is a lengthy process. While such evolutions would signal Europe's renewed focus on defense, they are likely to have a contained macroeconomic impact. Europe's defense spending focuses heavily on imports rather than domestically produced goods, so increased spending is unlikely to have a potent growth multiplier. We estimate that if defense spending is raised by 0.5 to 1 percentage points over a couple of years, the impact on European growth could be about 0.1 to 0.2 points per year. All of this comes against a backdrop of a fairly austere fiscal regime in Europe. In effect, the extra spending would merely offset some of the planned tightening rather than unleash a meaningful net fiscal boost. Note also that Europe's export-oriented growth model will be significantly challenged by the rise in global protectionism. For example, the steep rise in global trade uncertainty is likely to dent corporate investments, as seen during 2018 through 2019 in Trump's first term. The prospect of a possible resolution of the Russia-Ukraine conflict, which could entail lower gas prices and some boost from reconstruction efforts, could provide a partial offset, but likely only a modest one. Investment takeaways. Overall, the weak outlook for the German and European economies and ongoing disinflation mean that European duration remains attractive for European investors and can serve as a good diversifier in global portfolios, in our view. We also favor positioning for steeper yield curves, with the European Central Bank, ECB, likely to continue easing policy, and with higher sovereign issuance potentially leading to an underperformance of longer maturity bonds. Thank you for listening. That was Hope and Hype on German and EU fiscal reforms. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcast may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.